Hi guys, David Jennings here. Just wanted to make a video for you just in regards to structuring and perhaps some ideas and thoughts that you might then be able to take to your financial advisor and see if you're structured in the best possible way for both asset protection and also tax minimization purposes. Now obviously I'm no financial advisor, so anything that I say shouldn't be taken as financial advice, and you should definitely seek the consultation of your own financial advisors before making any decisions. I'm going to talk in really general terms. I don't know your financial position, so just use this maybe to spark some ideas and perhaps help you ask the questions of your advisor. The other thing I wanted to talk about was or make you aware is I'm based here in Australia, so the structures that I'm going to talk about are Australian. That said though, I know over in the States and other parts of the world there are similar structures, perhaps just with different names. So the idea I think still remains the same. It's just a matter of finding out from your advisor what the best structure is to achieve the outcomes that you're wanting to look at. So I want to talk a little bit about a structure that I've been doing some research on and think it's quite effective, and perhaps you might have a look at it and see if it applies to you. I think the first thing that we need to talk about is there's two types of structures that we want to talk about. Firstly, you've got companies. Now companies are a great way to set yourself up when you're starting out at the trading business, or any business for that matter. I know there are a lot of benefits from setting yourself up as a company or a business, and you always hear people talking in terms of trading as a business. And the reason you want to trade as a business are a few things. I suppose some people talk about it in terms of approaching their trading very clinically, but in addition to that, there's also some benefits from actually treating your business as a trading. A lot of your expenses then become tax write-offs against any profits made from your trading. So you can start to write off things like, computers, office space if you've got it, certain technology, trading software, all that sort of thing. So there's a whole host of reasons why you might look at setting yourself up as a business. In addition to that, you've got benefits on when you can actually spend money and offset income against expenses. See, when you're set up as an individual and you're set up as an employee and you're pulling a wage from someone, the employer will take the tax out before you get the money, and you're basically getting after-tax dollars. Then if you want to go out and buy any expenses and things like that, you're doing it after tax. Now, if you set yourself up as a business, the tax isn't taken out as the income is made. So basically what enables you to do is have the income come in, then you go out and spend your expenses, and then you're taxed on what's left, which is, in direct contrast to the way it works on an individual, where you basically make an income, you're taxed, and then you can buy on what's left after tax. So companies were the first structure that I looked at, and it's a proprietary limited here in Australia. Now, it's not the most effective structure. There is a time and a place for it, and I did use a structure like this originally, but moving forward now, I think finding out about trusts and the way to set up company trust structures, they're a lot more effective as a structure to set yourself up with. So I'm just going to have a look here. We'll start off, and I'm going to call these two structures up the top here. We're going to call this one T1, and we'll have T2. So I wanted to talk about, these are, it's going to be, we'll be talking about the company trust structure. So firstly, a trust has a lot of benefits as opposed to just a normal proprietary limited, both for asset protection and also income distribution at the end of the year. You see, a trust isn't able to hold any profits at the end of the financial year, whereas a company can hold profits till the end and then it pays 30 cents on the dollar in tax. A trust works a little bit differently. Any income generated within the trust then needs to be distributed out to what's known as its beneficiaries. Now, you can just set up a trust and then have an individual as the trustee, the controlling person of that particular trust, but you might want to have a look at getting a proprietary limited set up the top up here, which is the trustee for the trust. Now, the reason we do something like that is it creates, from an asset protection point of view, really does put an extra layer that someone needs to go through before they get back to the individual. Because we're a director of, or you might be a director of this company up the top here, which is the controlling entity of the trust. Now, mindful that no business actually goes on in this company up the top here. It's purely used for controlling the trust structure down here. If something goes wrong and for some reason this trust here becomes under scrutiny and someone tries to sue it or whatever, the party that's suing needs to first get through the trust structure, then get up through the proprietary limited structure before it can get back to the individual. So it can become a very time-consuming and very costly ordeal. So from an asset protection point of view, it's a very strong structure. So that's what I'm talking about when I'm talking about a company trust structure. Now here, let's actually look at a structure with a combination of trusts and companies and the way that it might work. So again, I'll just put the company up the top here just so we know we're talking about the same types of trusts. Now there are two trusts here, and what you might look at doing is firstly setting this one here as business and this one as assets. So over in here is where all of your business dealings are done, and effectively this structure here will become the risk taker. So if it's engaging in any activities, business or otherwise, that can put it in the limelight, you want to run all of those activities through the business trust. And effectively what you're doing is you're separating your business activities from your assets, further protecting your assets. And then basically over here in your assets trust, you use the assets trust to purchase any property. So you might have property. You might also have your trading float. And any other assets. Now, when I think in terms of assets, I'm talking about nothing that is business related, it's more just the actual asset itself. Now, we can talk about transferring funds between the two, but I just wanted to make sort of clear the reason we set up, or you might look at setting up something like this, is so that you're running your business activities on one side, which is very secure and separate from your assets. And your assets are put over in this separate trust, and then that way it's very separated, and from an asset protection point of view, it's very safe. Now let's talk in terms of the tax benefits from operating a structure like this. Now, a trust can be run in the same way that a proprietary limited can, in that you can basically have income and then offset any of those expenses against those income, except at the end of the financial year, what needs to happen is the income from this trust needs to be distributed out to its beneficiaries.